I don't know, maybe she's with me. I don't know, maybe she can hear me. I don't know. I'm not hearing from her, but that's not an issue. Since at least I can, you can hear me, at least we are good to go. I was actually thinking before that maybe you guys are not ready. Because if you are not ready, you may say I'm not ready. But since you have come online, I believe that we should be able to do one thing or the other. All right. I don't know, maybe you can see my screen. Can you see my screen?
Not yet, sir.
All right.
Okay, yes, I can see it now, sir.
All right. Thank you. Okay, as I said earlier, my name is Ade Ebukumi Israel. Um, Actually, there is no need of telling you my qualification. I don't think there is a need for that. But we are professional colleagues, and then by the grace of God, I will be taking you guys, SFM, myself together with uh, a guy, yeah, a guy like that. So I don't know what they might have told you about SFM. No, it's one of the causes in ICANN that many people are scared of. But one thing I used to say is that those people that are writing it and passing it, they are not, it's not that they are more intelligent or they are superhero. It's just that some of them they put in their best, some of them pray to God, and then they are where they are today. So whatever notion they have actually given to you as touching SFM, I would like that to first of all you raise that particular notion. You raise it, know that you can do it. Thank God the word I can means I can. Be positive about yourself, be positive about the the course, the level and the likes. And try to put in your best also. And we trust God to help us. So this is the introduction class. This is the first class. Or have you had any? No, I don't think so. This is the first class we'll be having in this diet. This is the first, and I will be starting with a topic that says capital asset pricing model, CAPM, capital asset pricing model, portfolio theory, and the capital asset pricing model, portfolio theory and capital asset pricing model. I believe you can hear me. I believe you can hear me, right?
Yes, I can hear you very well, sir.
All right, thank you. I just want to be sure that I'm not speaking to the ear. All right.
Yes, sir.
So now let me just give the overview of the topic. Just give the overview of the topic. Um, we have investors. We all know who an investors are. They try to put their money into a project with an expectation that it's going to yield a high return, with an expectation that they are going to get profits from that particular project. So they put their money into that project. As it is in the return, they will get their return. And at the end of everything, they will also get their capital. But let us take into it. Let us look into it from this angle. We know that portfolio. Maybe you have seen those who that used to read in 1980 that they will carry a portfolio bag, different kind of thing will be in that portfolio. There's even a particular date that you should not put your whatever in one basket or whatever. So it's just a thing whereby you are having different kind of investment, different kind of investments. So we will be talking about portfolio theory. We'll be talking about the capital asset pricing model. So let us try to see what we have here. I've actually splitted uh, the chapter 10. I've extracted it out. So we'll just be using the study pack, and where there is need, we will try to bring in a question, a standardized question, and we look into it together. All right. So I start from 10 stroke 2, that is risks and investments. Risk and investments. Risk and return. Investors invest in shares and bonds in the expectation of making a return. I think I've said that one earlier, that we invest, an average investor invests so that they can make a return on that particular investment. The return that they want from an investment could be described as a return, a return as reward for providing funds and keeping those funds invested, plus a return to compensate the investors for the risk. As a basic rules, an investor will expect a higher return when the investment risk is high. That's the normal speculation of man. When the risk is high, you actually expect what, higher return. For example, now all these people that do this Ponzi scheme, they will say they will say pay 5,000 in the next 5 days, pay 500,000 in 5 days, get 1.5 million. And many people, they will rush into it because they they know that the risk is actually high, but they know that if they can actually make it, they will actually get higher return as well. Yes, we have seen many people who made it from there, and we have seen many people who actually lose everything from that particular investment. So what am I trying to explain is that when the return is high, the risk also will be high. When the risk is high, the return of that on that investment will also be high. So what is now investment? What is investment risk? What is investment risk? Investors in bonds, investors in share and companies all face investment risk. In the case of bond, the risk for the investor as follow. Even if I should ask ourselves, what are the investment risks? Let me hear from us in your own basic knowledge of PM, FM, and the likes. What do you, and even in general term, we have all invested in one cryptocurrency, forex, and the likes. So, what do we refer to as investment risk? Can I have someone just to explain that to us? Investment risk. Do I have anybody? Excuse me. Is there anybody here who can explain to us the meaning of
Okay.
investment risk?
Yeah,
Thank
so
you.
with my okay little knowledge, I would say is the possibility of losing money or any less
Yeah,
than expected from an investment.
yeah. Thank you. The
Okay.
possibility of losing your money, losing your capital, you lose everything. Those of you that did MMA, lost everything. Some of them even lost their lives. So, from our knowledge, that general knowledge, now we got to know that investment is the possibility of maybe losing your money, losing your capital, even losing the reward or the return you want to actually get on that particular investment you have made. So, according to what they have written inside the pack here, said the risk fund for the investor are as follows. We have A, the bond issuer may default and fail to pay the interest on the bond. Yeah, if you invest in a particular bond and the bond is not yielding, they may refuse to pay the interest. I could remember, I think I invested in one stock like that. The last time I checked, I noticed that my money was actually going down. I just ignored it. Even now, my expectation now is that let it just rise so that they can repay my money. I'm not even interested in their interest again. So that is the first risk or investment risk. That is first investment risk. The issuer will default and fail to pay the interest on the bond or fail to repay the principal at maturity. Yes, we have said it the other time that it's the possibility of losing your money, losing your fund. You can lose everything entirely, and there are some strength by you will only lose the interest on it. They will still give you your capital again. They will give you your capital back, and there are some times whereby everything will be lost. Yeah. B, there may be a change in market rate of interest, including interest yield on bond. A change in yield will alter the market value of the bond. If interest rates rise, the market value of bond will fall, and the bond investors will suffer a loss in the value of the investment. So they put something here. Let's try to check it together. They said that Sorry, please. He said in the examination, you might be told to assume that debt capital is risk-free for the purpose of analyzing the cost of equity. In practice, however, only government debt denominated in the domestic currency of the government is risk-free. Only government debt is only is risk-free. Others are always, they are not risk-free, but there are some scenarios whereby they will actually ask you to assume that the risk-free rate of return is actually zero. Is actually zero. But we must know that in practice, only government debt denominated in domestic currency is actually risk-free. In the case of equity share, the risk for the investors are that the company might go into liquidation. In the case of liquidity share, now let's say we are not now talking about bonds, we are talking about share now. You actually bought share from a particular company or in a particular company. What are the investment risks you can actually get? The first is that the company might go into liquidation. They may not be able to they may not be able to actually go further with the business again, thereby going into liquidation. I believe we all know the meaning of liquidation. Are we together?
Yes, sir, we are together.
So, do we know the meaning of liquidation?
Yes, sir.
All right. And we know the meaning of bankruptcy as well.
Yes, sir.
All right. Oh God, who is this? All right. Excuse me, please. So let us move further. The company might go into liquidation. B, much more significantly, the company's profit might fluctuate and dividend might also rise or fall from year to year. So they are telling us that investment risk, we have talked about bonds, they may fail to, the bond issuer may default to fail to pay the interest, even they may refuse to pay the capital you have invested. So we are now talking about equity share now. The first risk is that the company might go into liquidation, and once they go into liquidation, there is tendency that you'll not be able to get the full amount of money you have actually invested into that particular company, depending on the nature of that company. Yeah. And then the most significantly, the profit might fluctuate. That means if your profit goes up, they may increase your dividend, and if it goes down, they may reduce your dividend, or they may not even pay, depending on the kind of share you're actually holding as well. For investors in equity, the biggest investment risk comes from uncertainty and change from one year to the next in annual profit and dividend. Change is expected. The changes in expected profit and dividend will affect the value of shares. Yeah, we know that if the profit makes profits, if the company makes profits, there's tendency that they will pay your dividend. They can even surprise you and give you more than you are expecting from them. And if it falls as well, they're ready for the same thing. So when a company invests in a new project, there will be an investment risk. When a company invests in a new, you know that there is individual investors. Like individually now, we can invest in a particular project. We can invest in. Please excuse me. Let me just try to plug my laptop. I think the battery is getting low. Still with you, please. All right, sorry for that. So I was talking about when a company can invest in a project, they may want to buy a particular asset. They can invest in projects, and individuals can invest in projects. So they are not saying that when a company invests in new projects, there will be an investment risk. This is the risk that the actual return from the investment will not be the same as the expected return, but could be higher or lower. We all know when they are trying to get a particular project, they are trying to invest in a particular project, they will face investment risk. It is either their expected return will be higher than what they are actually what they are foreseen, or it will be lower than that. The investment risk for company is similar to the investment risk facing equity investors. No, I said the other time that company can invest in a company, I mean, company can invest in the project, individual also can invest in a company or in a particular project. Some types of investment are more riskier or risky than other because of the nature of the industry and market. For example, investment by a supermarket group in building a new supermarket is likely to be less riskier than investment by an IT company in a new type of software. This is because the IT business is inherently more risky than the supermarket business. I believe we understood that particular statement. So let us just move to measuring risk as a variance or standard deviation. Standard deviation of expected return. Measuring risk as a variance. You can measure risk as a variance or a standard deviation of expected return. The risk of variance in annual profit and dividend can be measured when annual return can differ by a large amount from normal or expected average return, and there are considerable difference in return from one year to the next. Returns are volatile. High volatility in return is associated with high investment. Risk can be measured statistically either from an analysis of historical return achieved in the past or from probability estimated of return in the future. Risk can be measured statistically either from analysis of historical return achieved in the past. We can use our historical record to actually measure the risk, or we can make use of probability. The measurement of risk is a measurement of volatility of possible return. This volatility can be measured by as either the variance or standard deviation of expected return. For an investment, we can measure both for an investment, you can measure both A, an expected or average annual return, B, a variance. So when you want to calculate a variance now, using variance to measure the risk now, this is the formula, which is summation, probability of return versus probability of R minus R bar raised to power 2, where our P is the probability. Yeah, this particular sum, we all know that this is sum now. This is a sum sign. This is a sum sign, right? And we have P, which is probability. We have R, which is the amount of the return, and we have R bar, which is the average expected return on the investment. This is the expected value. So if we calculate everything now, we are going to get the expected value of the return. We should be familiar with this particular formula because for us coming from accounting background, we did probability, we did all these mean, media mode, standard deviation variance, and the likes like that. So it's still the same method and the same strategy. So let us see into how we can actually make use of this formula to solve a question. I believe we are all following, right?
Yes, sir.
All right. So they are telling you now that if you are not familiar with the calculation of a variance, study the following example. So I will assume that we are not coming from accounting background. I will assume that we jump skills, we jump foundation. And if you are coming from ATS, you jump ATS 1, you jump ATS 2, you jump ATS 3, you jump foundation, you jump skill, you just meet yourself in professional. So because of that, my assumption, we are going to see into how we can make use of this particular information to calculate our expected return. So we have probability, which is 0.2, 0.2, 0.5, 0.3. Then we have the return, which is 2, 6, 8. So let us go to our workings and see what can be done. Or we know it. Do we know it?
No, sir.
Sir?
I don't know it.
You don't know it. Okay. Let us try to see it what we can go
Yes,
with.
sir.
So we have probability. Sorry, please. So that it can be good enough. I mean, so we have probability. We want to calculate the expected value. That's what we want to calculate now. That formula, summation P into bracket R minus R bar, close bracket, raised to power 2, is the calculation for expected value. So now we have probability. So we have return. Let's call it that one R. Then we have R minus R. Sorry, oh. R minus R bar like this. Just it's R minus R bar. Then I'm going to navigate to put that bar. I don't know how I don't know how I'm going to navigate it. So let me just leave it like that because of our time. Because time is not our friend. So we have probability. So we have probability which is 0.2, 0.5, 0.3. 0.2, 0.5. Please try to get the calculator so that 0.6 so that we can work together. 0.3, 268, 0.23. So we have 6. You see, is in percentage already. And this one also is in percentage, 0.2, 0.2, 2%, and F4. So our expected value now, EV, expected value of return will now be probability multiplied by return. Probability multiplied by return. So if our probability is 0.2 and our return is 2, don't forget this one is 2%. 2%. Just let me leave that because of time. I don't my the button on my laptop is not well arranged, so I don't want to be looking for that one now. So this is 0.2 now. So 0.2 times 0.2 is going to give us what? Are we here?
It's going to give us 0.04.
Hello?
Yes, sir.
Are we together?
We are together, sir.
So 0.2 times 0.2 is going to give us what?
0.2 times. It's going to
What
give
will it
us
give us?
0.04.
0.04.
0.04.
Okay. What of the second?
0.5 times 0.06. 0.03.
So
0.
please let me respond to this message, please. I'm coming.
0.08.
0.06, right?
Yes.
What of the last one?
0.3 times 0.08. 0.024. 0.024.
0.02. All right. So now, don't forget, this is R minus R bar. I want to calculate our what? Sorry, please. Share your entire screen. Sorry, please. Let me try to zoom it. Can you actually see my screen very well? Can you see it very well? It's not really clear, right?
It's yes, it's not really clear.
What of now?
But it's okay.
It's still manageable like this, right? Can we manage it like this?
Yes, sir.
Okay, so this one is
Yes, sir.
0.034, right? All right. So now let us add these three together. 0.04, 0.06, 0.03. What do we have? What do we have? Is someone helping me?
Yes, sir.
All right. So, so what do we have altogether?
0.094.
The 3, right? 0.3
Yes.
times 0.8. Please let us check that calculation again.
Okay, sorry.
0.3.
0.3 times 0.8. That's 0.24.
Okay. So let's recalculate like that. Or let's see that. I just want us to, I want to engage us. That's what I'm asking us to. I know I can use formula, I know, but it will not be actually good if I'm the only one doing it. We have to do it together so that we understand how we are getting it. This is 0.5 times 0.06. This one self is 3. Is 0.03. 0.5 times 0.06 is 0.03. Are we together?
Yes, sir.
Yes, sir.
So what's your own total now? What have you gotten? No, this why this one is not pressing like this. You just give me your own answer. What's your answer? Are we together? Hello? Hello?
Yes, sir. We're
We
together.
are
I'm together. We're
together, sir.
together.
All right. You know what? You know what? Because this R is already in percentage. Are you getting me? It's already in percentage. So don't let us convert it again. Just multiply straight away. 0.02 times 2, 0.5 times 6, 0.3 times 8. Because this R is already in percentage already, as they have given to us in the question. So if we say 0.2 times 2, that's going to give us 0.4. 0.4. Then if we say 0.5 times 6, that is going to give us what? 3. 3. So if we say 0.3 times 8, that's going to give us
3.0.
that's going to give us 2.4. Yeah, 2.4.
2.4.
So if we now add everything together, that's going to give us this one is 5.4. 5.4 plus 0.4, that is 5.8.
5.8.
5.8. So these are now these are these are expected value. These are mean. So as you can see, mean bar R. But don't forget this is expected return, expected value of return. So now we can actually use this particular format as well to get our variance. So if we want to get variance now, then we just as we will normally do it in our 100 level, 200 level days. I haven't gotten our RP. Sorry, this one is just RP straight away. It's not R minus R yet. RP. That is our R, this is probability, our P, multiplied by our RP. Then we move to R minus R bar. This is our R bar now. This is our mean. 5.8 is our mean. Then we now say R minus R bar. So R minus R minus R bar. That means, okay. Okay. Which one is this one like this? Okay, just give me the answer. 2 R minus R bar. This is our R bar, 5.8. 5.8 minus R, that's going to give us what? Are we together? Are we together?
Yes, sir, we have. Your screen is not really
All
clear
right,
for me,
give me.
so I can barely see what you're
You
talking
cannot
about.
see my screen. That's it. That's something new. What can I do again? Let me try to zoom it. I don't know this why you are not seeing my screen. I've already zoomed and I've zoomed this thing. Zoom it. I don't know why you are not. I'm sharing the full screen. Just manage it for today. I will try to see into how I can get it better, maybe subsequently. Just give me the what's it called now? Subtract hard bar. This is our hard bar now. This is our hard bar. This particular was a hard bar. So our hard bar minus R, what do we have?
3.8.
3.8. What of this one? 5.8. This is our hard bar minus R, which is 6. What do we have?
Minus 0.2. Minus 0.2.
Minus 0.2. What of the last one?
Minus 2.2.
Okay. Minus 0.2. Minus 2.2, right?
Yes, sir.
So now, the next thing we are going to do now is that we are going to check for R minus R bar square. This is R minus R bar. Let me just write it in full. R minus Then this one will now be R minus R basket, R minus R. That is what we have here. This R minus R basket, R minus R bar that we have here. Just care it here. So let me just look for 2. Are we there?
Yes, sir. Yes, sir.
Raised to power 2 should give us 0.04. 0.04. 0.04. And then the last one, which is 2.2 raised to power 2, should give us 4.84. 4.84. So if we add the three together, 1.44. Don't forget this one is because I don't really get how to navigate. It's supposed to be R minus 0.84. So if we add the three together, okay. If we add the three together, then we are going to have 14.44, 0.04, 4.84. If we add this together, we are going to have a particular value. That's not where we are going to the variance. Then we now see our probability into brackets. What we have here, what we have R bar close bracket raised to power 2. Just bring this one here. What is there? Just bring it here. So if we put it here, so now what you're now going to do is that you will take this 0.2 multiplied by what we have here. Are we all together?
Yes, sir.
Are we together?
Yes, sir. So please, can you scroll down a bit? We are not seeing the other,
You are not seeing this.
the last part.
Okay, okay.
Yeah, can you scroll down?
Can you see it now?
No, sir. It only
Is
stops
it
at
visible?
0.5. We can see 0.2,
0.5.
0.5. Then we can't see the remaining value. That's for 0.3.
Wow.
Uh,
Wow. Okay. What of now?
No. I think you move the slide down.
We need to go and see my Oga so that they can teach me this because this stuff is just frustrating itself. Okay. Okay, let me check something. Let me check something. Call me please. I don't know the hello. Please, can you see my 4444? Can you see my is it clear now?
Yes, sir. Yes, sir, it's clear.
Sorry for that. What of now? What of this one?
I can only see the spreadsheet.
Sorry, Mr. Israel, sorry.
Okay.
Do you share your entire screen or you are just sharing this? There is